Good morning, folks. Very good morning to all participants. Do write in the chat box where you are logging in from. We'll take a few minutes before we will start. Good morning, Kushal. Good morning, Akpen. I'll take the queries in the second half of the video. Good morning, AK Sensation. Good morning, Prakhar. From Dubai. Must be early for you. No. Yeah. Good morning, Nikhil. Good morning, Sachin from Pune. We'll start in a couple of minutes. Good morning, Sri Sakti. Hi, Nikhil from Bangalore. Good morning, Devajit from Assam. Quite a wide distribution of audience today. Good morning, Shabazz. Good morning, Dr. Ganguly. Few more seconds and then we will start. Okay, so we are 3 minutes in. We'll start the live session. Good morning, Saikiran. Good morning, Sampath. So we are going to talk about some market dynamics that has happened in the last month. It's a monthly meet. We share a lot of daily data and weekly data with you. But when we see the markets on a monthly basis, it gives us a bigger, larger picture, so as to say. So let me just pull up. Charts here. Okay. Go to monthly mode. Okay. So this is where we are on a monthly basis on the Nifty. You can see we are in the third month of uh, advancing, and typically an advancing phase continuously goes on for 4 months, or sometimes in rarity even 5 months. So we still could have uh, a good December and January on the Nifty. That's what would be my guess. The fact that we have closed a monthly chart at a new high is always a high probability event of further gains. So whenever you will have all-time highs on any stock sector market, the probability of it going further up is quite high. And Nifty has done that, although the only big thorn in the entire story is that the entire market is not pulling along. So if we were to look at even within the large caps, if we look at Nifty Junior is still far from its all-time high, about 10% lower. Although, I mean, if we were to compare Nifty and Nifty Junior together, um, then you would see, over a longer period of time, let's say even since the last few years, uh, Nifty has not done so poorly versus Nifty Junior. In fact, Nifty Junior is still ahead over the last few years. Both of them are of the nature of large cap stocks. And while the Nifty Junior is looking bad in terms of its, um, drawdown from its recent high, but whenever you're looking at equity markets, you need to look at it from a longer term rolling returns kind of basis. And there you will find that, this fall from here is still not causing Nifty Junior to have underperformed the Nifty, and it is still performing very well versus the Nifty. And that is expected also because Nifty next 50 stocks are slightly higher beta stocks than Nifty. But this general sort of, approach that if it is down from all-time high, then it is not good, that, is certainly not playing out here. Both Nifty Junior and Nifty are doing quite all right. If we look at, let's say, uh, mid cap stocks, so mid cap 150, let's remove the Nifty for a second and look at the monthly charts. Then mid caps also are peaking into an all-time high, and there is a, cup and handle pattern for, and all of you who may be following some technical patterns also, this is a strong pattern that can cause, and especially if it occurs on a monthly chart, it would have a reasonably good probability of going higher. If you look at small cap stocks, here we have, again, just like Nifty Junior, we are trailing the all-time high by about 10 odd percent on the index. But if we go down in the details of the small cap makeup, you'll find a lot of stocks are at minus 50%, minus 60%. So the distribution is really bad. And I'll show you those charts also shortly. Now, if we were to compare this with, let's say, mid cap stocks, um, um, so let's take Nifty mid cap. Okay. And let's take a line chart for both. So now here again, you are seeing the same phenomena that we are seeing between Nifty and Nifty Junior, is that while mid caps are at all time highs and small caps are down roughly, 10 to 15% from the top, but over a significantly longer period, both have done quite well. In fact, uh, if we go down to even 4 or 5 years, you're finding that mid caps and small caps have performed well. So what has happened is that whenever there is a sort of a brutal strength or a very strong rally that happens, the higher beta stocks like the ones in small caps, or in the context of larger caps like the one in Nifty Junior, they tend to outperform in a very big way. And that outperformance then sort of, uh, reverts to the mean whenever the markets are dull, and that's what's happening now. So overall, if you see the 3 5 year returns on the markets, they will not look so bad. But yes, over 1 year period, many indices, many strategies also will not look so good. This also needs to be seen in context of, the market uh, stagnating this year, is that, where have we come from? Let's take a longer view and say, this is our logarithmic chart of the last whatever 10-15 years you want to see. So you can see that this was an aberration in 2005 to 8, where the GFC crisis, pre-GFC crisis, the emerging market bull rally was there, and then of course the GFC was there. But post that, once the market has normalized, you are seeing that the market is chugging along a certain path, and some deviations are there sometime, but pretty much we are on that track, and there is no deviation as such. There was a COVID deviation here, and the demonetization deviation here, but really speaking, we are on a path which is reasonably sustainable, and currently doesn't look like we are deviating from that. So from all that perspective, it basically means that the markets will take a a small time to maybe outperform, and then maybe take a longer time to revert to the mean, and that cycle will continue to happen. The same you can see also on small cap stocks also. Small caps, okay, let's take the BSC small cap because the data is available on that more. um, no, not this one. Here you can see that small caps humongously sort of outperform at times, like this period of 5 to 2005 to 8, small cap going up 3x within a matter of 2 years, and then consolidating, and then going up, consolidating, and then this run up since 2021 has been like a 3x gain again, and that is basically what is consolidating, time consolidation, and reverting to the mean. Again here, I mean, it's not really even dropping like previous corrections. It is doing a time correction, and once that is done with, just like this time, just like here, perhaps we will also see a run up on that. So that's the sort of context we need to see the market with, in the sense that we cannot really, you know, have every year as a great year in the market. The uh, the signs are there now that the market has consolidated reasonably, especially um, on the larger cap space. So just like we were consolidating here, let me just remove this drawing here. So we consolidated quite a bit after this run up in 21 to 23, and we had a great run up from March 23 to September 24, and we have consolidated for about 12 months right here. So another leg of this kind is possible, certainly, now that the market is hitting new highs, or we may spend some more time and then do that. Uh, there has been enough number of bad news on the horizon, whether it is related to tariffs, whether it is related to slower GDP growth, whether it is related to any carry trade, Japanese carry trade fears, rupee slipping down. Enough negativity has been thrown at the market, and the market is absorbing all that negativity and still maintaining at a high. So that tells you that the inherent strength of the market is certainly there. Otherwise, it would have dropped by 20% by now if it was succumbing to all these pressures. So the idea is that we should read the signals of the market, how the market is reacting to bad news. That is the best way of seeing where is the underlying strength, in what pockets is the market advancing even during weakness, and what are those sectors which are not performing even when markets are advancing. So you get the clarity on both sides when you do that. um, if you look at, let's also look at, let me just change my screen and show you um, the distribution within the markets. Just give me a second. So this one. So this is a market breadth analysis. I hope you can see the screen. Um, Here, the top 750 stocks are categorized as different market caps of top 50, 50 to 100, 100 to 150, and so on and so forth. And you just need to look at perhaps a shorter term 1 month picture, which is the second column here, and the longer term 1 year picture, which is the last column here. So in the shorter term, in the last 1 month, what has happened is most categories of market caps beyond the top 200 stocks have an average loss, which ranges from 2 3% up to even 10%. And even the top 200 market cap stocks haven't really, on average, gone anywhere. They're just about at plus 0.7, 0.2, minus 0.2, and so on and so forth. So the last month performance basically is that the larger cap part of the market is stagnant and rest of the market is still bleeding. That is the sort of monthly picture that you can paint out of this. Over the last 1 year, you can say that the entire market is trying to stabilize, where only these very sort of below 500 market cap stocks are still continuing to bleed, and the rest are trying to stabilize. Although the gains here only in the large cap space have reached double digit, otherwise, it is all very scattered in low single digits plus or minus uh, average returns. So it is a year of sort of consolidation that is going on, and the larger market cap part of the market is trying to lead the market. Now the question remains whether there will be enough strength, enough momentum, enough liquidity that flows to the larger caps that they start a new bull rally, and then that bull rally percolates to mid caps, small caps, micro caps over a period of time. That is this normal sequence that would happen for a healthy broader market up rally to happen. So that's about stocks. Let's also look at how the FI trends are playing out. So in the last 1 month, there is still FII outflow that is happening. So about 19,600 crores have moved out on FII flow, but about 95,000 crores have been pumped in also by domestic institutions. So the domestic institutions continue to overwhelm the selling of FIIs. Although having said that, there is a significant sentiment that gets attached to FII flows. So you will never see the markets go up if DIIs are buying, but if FIIs are buying, you will see the market sentiment become immediately good. And I'll show you that data point just this week. Only one day FIIs really bought heavily, 4,700 crores on Wednesday. And that was the day the market really rocketed up. So the markets give a sort of an unequal weightage to FII flows, and whenever FII flows are doing well inwards, markets do well. Now, what has happened also is that the FII outflow has been slowing down over the last few months. In fact, couple of months back, it had reached even 0 point where no negative flow was there. But this month there is 19,000 net negative crore. I feel that in times to come, this figure will again turn positive. Perhaps early next year, and that probably will be a very big sentiment change for our markets. Um, let's also look at some other charts or commodity charts, US charts. So S&P 500, if we see, this is a weekly chart, but if you see on a monthly basis, we have closed at a new all-time high on a monthly basis. If you see gold, this is again a weekly chart, but on a monthly basis, again we have closed on a new all-time high monthly basis. Silver is also on an all-time high monthly basis, highest close. So all these markets are basically telling you that allocation to assets is very, very important. The pricing in of vast amount of QE or some sort of stimulus, because there is still a lot of talk about Fed is going to cut heavily in times to come. Perhaps one cut will come in December itself. RBI also may cut in the next meet. So RBI has a very, I would say, very positive situation to deal with this time. In that, just yesterday we've got some fantastic GDP figures, although uh, nominal GDP figure is not very high because inflation is very low. And typically, markets follow nominal GDP figures. If nominal GDP figure is high, markets do well. So some inflation is good for the markets. So now with decent real GDP, very low inflation rates, it is a opportune time for RBI to cut very heavily, perhaps even half a percent in the December meet. And as soon as the market, if it does, and if the market gets a whiff of it before that, I think the markets are going to have stronger momentum on the higher side, because all the banking, finance, autos have already started to, I think, sense that move and started to go up. So that can be a big trigger for India for December. And then January is obviously, always new allocations to emerging markets, as well as, the expectations of budgets, where some murmurs of large PSU banking restructuring, public sector enterprise restructuring are already sort of doing the rounds. So there are some triggers that can really cause the markets to do well. In absence of any good news in the last few months, we have not seen the markets tank. I think that, at least from a Nifty larger cap perspective, I think that is the real good news of the market. Yes, the smaller cap, micro cap part of the market is still adjusting, and it's still reverting to the mean, and that may require some other trigger to really go up anytime soon. So this is, and let me also look at the, let me show you the dollar index chart also. One second. Um, um, so this is the monthly USD INR chart, and you can see that we are racing fourth. In just the last 5 6 months, we've gone from 84 to 89 plus, and more often than not, whenever our currency is slipping, uh, nominally our market starts to look good and they start to go up. In dollar terms, of course, we may not be moving much, but on in rupee terms, because the RBI had been holding up the rupee sort of artificially versus other Asian currencies, Indian rupee has become more expensive vis-a-vis its peers. And as the Japanese situation, like we did a recent video, in case you haven't seen it, please do. Uh, the Japanese currency may go for a deep dive versus the US dollar as they increase the stimulus and as they try to uh, you know uh, allow the currency to fall versus the USD. I think that is going to have a very big ripple effect on Asian currencies and Indian rupee. And perhaps that is why we are seeing our currency go towards 90. And I won't be surprised if next month we are above 90 on this front. So some exports will benefit, IT of course will benefit, pharma will benefit, and in general, some benefit is there for nominal GDP to grow. The only issue will be oil, but oil fortunately is in a very benign state, and oil has not really gone anywhere. And JP Morgan has come out with a report looking for oil in the 30s in the next few years. And if that happens, it will be a great uh, sort of outcome for India from a uh, you know current account point of view. So, with that sort of background of the market, I'll open it up for questions. We are at 11:25. We can take up another half an hour of questions, and I'll try to start from the top wherever I got one question from. So, Mr. AK Payne says, appreciate our content on asset allocation, momentum investing. How would you compare Indian REITs versus real estate investments? Can REITs be considered as good hassle-free proxies? So my view is that if you are looking for income generating real estate, then perhaps REITs is a good option. It's hassle free for sure, but every hassle free option comes with its pound of flesh, wherein the manager who is managing the assets for you, who is taking the hassle for you, will take a piece of the pie. So if you and REITs in India are still, I would say, an emerging asset class wherein we've not had too many players or too long a performance, metric available for any player of, any outstanding nature. I haven't really followed. I don't own any REITs, so I haven't really followed that space too much. But my view is that if you are a very long-term player in real estate and you are playing it for the real estate capital gain, then direct real estate investments can be a much better option. It's a very simpler and easier method to get some income based on real estate. If you go to REITs, it is reasonably stable, I would believe, uh, because most of these investments are in big IT parks and corporate offices. So the income is reasonably stable, but it is not anywhere near what real estate investments directly can get you if you pick the right real estate. So that's sort of my view on REITs. Let me go to the next question. Mhm. Trip Panda says, do you think India will be affected if AI bubble bursts, and would there be a quick recovery given the good GDP growth and stock market not growing since 14 months? So I think, like any other shock, if there is a big shock to the entire global equity system, then India cannot stay, unimpacted, non-impacted because of that. In the short term, everything gets impacted. But yes, once some dust settles, um, people may realize that we anyways don't have much AI exposure in terms of India companies, and perhaps there may be a revaluation of the India services companies and the back office services that we provide to the rest of the world. So from that perspective, I'm not so sure if any AI impact really can be there for medium to long term. But also, there's too much talk about AI bubble bursting. When there's too much talk about something, it usually doesn't happen. So, from all perspectives, I think um, perhaps we are not yet there, but you never know. Nobody can really say. Ayush says, do technicals in chart support resistance patterns, etc., work the same in micro cap stock as it does in large caps? Are there more chances of failure due to lack of liquidity and operators gain? Um, that is absolutely right, Ayush. The efficacy and the probability and the you know smoothness of patterns and the consistency of technical parameters that you see in larger caps is certainly not there in micro cap stocks. It is basically to do with what you have rightly mentioned. One is, of course, lack of liquidity. So one um, smaller player is also able to move around the market for a micro cap stocks without too much of buying or selling. The promoters probably are also a lot more often interested parties in that category of stocks, because they are also wanting to go to graduate to small cap to mid cap to large cap. And operators, market operators, which who are looking to make sizable gains by some price manipulation, find it that it is easiest to do in micro cap stocks. So while the probability may be lower of success of patterns, but the quantum of opportunities and the scale of gain that you may get in micro cap and small cap stocks may not be same as large cap. So while there is a give and take that is happening, there is also gain that can happen in micro cap stocks. Of course, you have to see what is your uh, liquidity situation in terms of how much you are allocating to each stock. And if you are a larger trader, then perhaps even if 2 5% 10% allocation to one stock may be a significant part of the daily volume of that stock. If that becomes the situation, you will become the elephant in the room, and the market will not allow you to exit easily. So you should always sort of, as a thumb rule, if your buying and selling is going to be more than a few percentage of the daily average volume, there is no point being there. If you become like the 10% 20% volume of the day for any stock, then your orders itself will start the stock to be hitting circuits up and down because of the liquidity. um, अक्षत says silver बीस सिल्वर एमसीएक्स से 4-5 हजार नीचे क्यों चल रहा है कुछ दिनों से. So silver Bs and silver MCX are very different animals, as we have seen in the past. Let's put up this chart. Actually, it's interesting. So silver Bs. Let's take a daily chart and let's add silver MCX. So silver. So this is where we are. Uh, this is basically telling you that there is a premium in the marketplace right now. The blue line is that of the futures. So the futures are pricing in some premium, whereas the ETF is not pricing in that premium. So the ETF probably, uh, you know, and it was exactly the reverse in October, where the ETF was having a lot of premium over the MCX price, and now it is the reverse. So this is a lot of market dynamics, which is very difficult to explain at this point of time. I know physical delivery was extremely difficult to find, and uh, ETF uh, buyers were plentiful. Now that they were somebody who bought here, actually silver price has gone up from here, but they are still in a loss. So that selling pressure, that resistance is there in the market, because all these people who bought here are stuck. Their silver price has gone up, but they have not realized their original buying price. Until they get cleared from the system, this premium probably will not come. So it is a demand supply issue. Silver exchange traded funds are extremely thinly traded. Um, we did some videos on this, and there was some industry pushback also on that. But uh, in my view, ETF AMCs should make sure that they are able to give a bid ask of a fair NAV to buyers and sellers. But for whatever reason, I mean, uh, these inefficiencies exist. So in some view, I mean, unless the if the ETF is trading below the NAV, and you can check the INAV on the on the AMC website, etc. Even in the NSE description, you will have that. If it is trading below that, you are buying ETF at a discount, and you can sort of wait till some premium occurs at some point. So no harm in doing that if you are buying at a discount. The harm usually is when you are buying at a premium. So I hope some clarity is there on this. NHD says, do you see major correction in next 1 2 years? Nobody can really, predict what correction will happen when. But usually, what will happen is that corrections will not start after a year and a half of consolidation. That is for sure. That, like, we have consolidated for almost 15 months now. So it's a time correction that is happening and some price correction in some stocks that is happening. A sharp correction now will only be possible if there is some external impact, maybe some war, maybe for whatever reason oil spikes, maybe something, some external shock is needed now for a major correction. Otherwise, it won't come easily. I mean, if 50% tariff has not caused a correction in our markets, it tells you the resilience of the market, at least at this point. Okay, the page says, what is the name of US top 10 strategy on vested platform? I tried but could not find it. So, the weekend investing strategy on US stocks is live on vested, but it is not there. It is only by invitation right now. Once the formal launch is there, then it will be available on the vested platform. You can write an email to global markets at weekendinvesting.com. There's a separate team that takes care of uh, this particular uh, segment of our business. I'll just write the email in the chat box also if somebody wants to connect. Global markets at weekendinvesting.com. So we have one strategy there on S&P 100 stocks, 10 stock strategies there, and more strategies will be added in due course of time. Um, Arjun says, if you had to distill your entire investment philosophy into one core maxim, what would it be? It is very, very simple, Arjun. We will buy what goes up, we will sell what goes down. That is the entire investment philosophy. If I were to explain it to a 5-year-old, and on top of that, to have very clear rules about whatever we are doing, what to buy, when to buy, how much to buy, when to sell. All that clarity needs to be there. There is no if and but. There is no thinking about it whether I should or should not. There is no thinking about, at least for my own portfolio, how I want to allocate my assets in terms of asset allocation. I have no thoughts about breaking my rules and trying to make more money, even if it were to be possible. So, from all those perspectives, I think having a clear set of rules in your mind, what you are intending to do, and then you go ahead and do it. And then at some point of time, if you feel that this is not as per what my thought process is, then you can perhaps try something else. That is also because my philosophy may not gel with everybody else's philosophy. So there is different philosophies people have, and you need to come to terms with one set of philosophy and then go along, and that will probably be a very, very uh, mentally peaceful investing journey for you. I mean, we all have to achieve a point where investments are not bothering us in terms of the market moving up and down, some other asset is going up, we are having FOMO. All that should be out of your system over a period of time. It won't happen immediately, but over a period of time, you will come to a situation where it, you will sort of distance yourself from whatever is happening and you will be happy with whatever is happening. Sai Kiran says, why do markets fluctuate on expiry days? This is primarily a function of uh, options trading, where significant number of expiry options are uh, being bet upon, and the outcome of that is basically dependent upon how the market will close. And interested parties who have accumulated those expiry options will try to manipulate or influence the outcome of the market on that day, just like the Jane Street case that we've been reading about. How to come out of a regret, like I should have sold my stock or hold or should have bought more. So there should be no regret in the market. You have to try achieve a point where there is no regret. The regret is happening because you are attaching yourself to a particular position or a stock. You are having an emotional attachment with a stock, and that is not allowing you to sell it at the right time, or you don't have your rules in place where, let's say you were investing 5% of your portfolio in each stock. Now you have a new stock that comes up in your filter and you want to buy that, and you invested only 1% because perhaps you don't like the name, or perhaps you are not so confident about it. So whenever you will break your rules, you will regret basically. So you have to try to come to a place of peace in your mind where you are doing it mechanically in a military like fashion, and don't allow any one event of a buy or a sell or a profit or a loss to impact you overall. You have to look at a entire gamut of trades over 3 year 5 year period. I have done so many I've done 500 trades. 250 have gone in loss, 250 have gone in profit. The ones in profit have given me considerably large average profit, versus the ones that I have lost considerably less average loss. That is the whole game, the casino math that we keep talking about. It is actually that that you need to imbibe in your system, that each one trade, each one stock is meaningless. It does not even matter what the stock name is, what it does. You have to appear to yourself to be disassociated with each stock and each trade. Arun says, can you or will start ETF momentum kind of small case for small investors? So we have a all season strategy which is purely ETF based. It is a dynamic strategy which invests in Nifty ETF and gold ETF, and it will allocate different weights to each ETF as the market goes. So it's not a direct momentum style of investing, but it's an asset allocation style of ETF small case that we have. Arshad says, while individual strategies manage stock entry and exit, I need guidance on when to enter, exit, or partially exit different strategies. Example, momentum strategies have a strong year but long drawdowns. So the way to do this would be to figure out a asset allocation rebalancing mechanism wherein you take away money from your uh, best performing assets and rebalance your overall portfolio. So let's say you had in the last 1 year equity, gold, and perhaps let's say bonds. So equity, let's say, has not really done well. Bonds are, let's say, have returned 6%. but gold has returned 60% to you. So now in that case, what you can do is, redistribute your assets at the end of the year. That 60% additional that you got from gold will get reallocated to all three, so that you've rebalanced your overall portfolio. Now there are pluses and minuses of doing this. The minus side here is that if gold were to do another 60% next year, then you are not, you know, accumulating your gains from this year. The plus side is that if other asset classes do well next year, you would have more capital deployed in those asset classes, and you never know what's going to happen next year. So, as a prudent measure, I would say try not to time asset allocation and try to do this. But if you feel very strongly about a certain asset class that I am able to dynamically allocate to that asset class before that asset class moves, then of course go ahead and do that also. Nikhil says, how do you see the direction of small and mid caps considering both have seen a reversal from the mean at lower end levels? Good time to enter. I think whenever we have a year and a half of consolidation in any part of the market, that's a great time to be, you know, reinforcing your exposure to that segment. Of course, there have been times where segments don't move for 3 to 5 years also. So there is no sort of assurance or guarantee that we can do in terms of timing. But a year and a half is a good consolidation time for any asset class to be gradually uh, entering into. AD2023 says, what could be the impact on REITs with reclassification as equity, and talks about including them in the index? Uh, I'm not sure about this one. I will read up on this, and perhaps next time we can discuss this. DS4B4SD. I wish everybody would put their name uh, in their account, so that I would start to recognize folks who are coming in. But nevertheless, since no new SGB is issued, is it a good idea to buy SGB from market which are going to expire in next 2 3 years or more? I think if you analyze the SGB and you find that it is giving you good value, it is giving you perhaps some discount to fair value, then certainly it's a great buy, because you are getting tax free gain from today till its maturity. Um, 3 year, 2 year or more is preferable from a taxation point of view, just in case there is a question, although it is not very clear in the taxation issue, whether if you buy today and your maturity is a year and a half later, whether that will be taken as long term capital gains tax free or not. But 2 years or more, certainly you can argue for that uh, situation. And there are SGBs that are going to expire, I think, in 2031 or 2032 also, which are available. So those are probably the ones to go for if you are a long-term investor in gold. Um, a lot of repeat questions. So I'm trying to find somebody who's not yet asked. Okay. Seziza says, I am running an equal weight momentum portfolio in which weekly rebalance and fortnightly position resizing, but I'm feeling that by position resizing, I'm cutting short the gains. Please guide. So it is basically a question of how aggressive you would like your strategy to be. If you want your gainers to stay on for longer with higher position size, you could you could perhaps take that position sizing away from fortnightly to a quarter. Allow the stock to run for a quarter and then position size it. Or if you would further like to sort of allow it to run till it exits, then never sort of do the position size unless it starts to hit, maybe like if you have 20 stocks, you started at 5%. If it hits 20-25%, then it becomes like a concentrated bet in your portfolio. Then you could have some rules around that. Um, so from that perspective, it all depends upon your design. There is really no right or wrong answer here. There are many strategies we also have where we reset the position size every month, and it has helped in many times. Uh, because a lot of times when the market is frothy, you are also taking away money from the froth and saving yourself. Um, Vipul says, what should a weekend investor keep in mind when strategy is not performing or in loss for a period? You have to see what is your expectation from the markets, what is your expectation from the strategy. Is your expectation that it should give me returns every year? Then perhaps that expectation itself is a bit misplaced. Equity markets are longer term instruments. If you get money in the short term, and I'm talking about investing, not short term trading, then that's something lucky. Even Warren Buffett has, trailed the markets, or even bigger, any fund manager, any large respectable fund manager has trailed the markets for long periods of time, and then they have also outperformed the markets for long periods of time. So every strategy will have its sort of mean reversion happening. Every strategy will go through, long phases of underperformance, and then you may have 1 year that covers up for the last 3 years. So you need to have that gumption and that perseverance to stay in the strategy. Of course, always have a distribution of different segments of the market in your uh, portfolio. So also have large caps, because at different times, different segments will perform. If for the last year, year and a half, mid caps and small caps have not performed, perhaps gold is performing, perhaps US stocks are performing, perhaps large caps are now performing. So that kind of distribution, asset allocation is required to keep your entire portfolio in balance. Dinush says, Dinushiv, sorry, says, good morning. SEBI has allowed SIF funds to do naked shorts. Is it not risky for normal investors, even those who don't invest in them, as their large corpus can negatively influence markets? So this is a very new instrument. Certainly, there are no fund managers who have vast experience of this. I am not sure what kind of outcomes will come out of this, because the liquidity of our markets, especially in cash markets, is very, very poor. And if large amounts of money are going to run on, uh, a long short style, you may find that one, you know, very very few managers having experience of that, and two, liquidity concerns may crop up. So it is very early days. If you look at hedge funds overseas, the hedge fund percentage of hedge funds outperforming record is not very good. Yes, from time to time, some hedge funds have done tremendously well, but then that mindset of the mutual fund investor is very different from the mindset that is required to be in this uh, different style of investing. So if you are keen for this, maybe try some money on this, and if it suits your volatility palette, then certainly add more. Any plans to start training, coaching for momentum based investing? I think everything that we do here, in terms of content, in terms of all these Q&As, Ask Weekend Investing, is geared towards trying to solve queries for people who are gearing themselves up for their own investing, momentum investing, or behavioral sort of approach to correct their behavioral approach, etc. So we have last question now. We are at the end of time. How to come out of regret? Oh, I've taken this up. Sorry. Last one can be this. How SIPs would perform in a consolidated market? See, Nifty 50 rose about 15% from bottom, so one would still be in gains in this last 1 year if one had stayed invested with SIPs. Yes, so the whole purpose of SIPs is to get dollar cost averaging. So as even if you start from the top of the market and the market goes down, then you are dollar cost averaging, and as the market comes up, your gains will start. So while SIP is not the end all for any kind of great strategy, but it is the simplicity of that strategy that attracts people. And essentially it is a no brainer kind of strategy where if you but the downside of that is if you are sipping and you basically are uh, let's say there's a year and a half of rally and you start at the bottom, then most of your sips perhaps will come at the top, and then when there is consolidation you may feel very frustrated. So plan for continuous sips over long periods of time. Plan for not stopping your sips at any point of time, and then perhaps in 5 to 7 years you will really start to see the magic of having continuously invested and the outcomes that you get from that. So I think that's all I have for today. Thank you so much for all of you to have joined today. uh, and I wish you a great weekend. Let's meet again next month. Thanks. Bye.